Ridiculous investment decisions often stem from a combination of emotional biases, lack of research, and misguided strategies. These decisions can lead to significant financial losses and serve as cautionary tales for investors. Let's delve into some examples of these ill-advised choices, explore the underlying causes, and discuss how to avoid making similar mistakes. 1. Chasing the hype. One of the most common ridiculous investment decisions is chasing hype without conducting proper research. Investors often get swept up in the excitement of a rapidly rising stock or asset, only to find themselves buying at inflated prices. Example: the dot-com bubble of the late 1990s saw investors flocking to technology stocks with little regard for their actual business models or profitability. When the bubble burst, many were left with worthless shares. Cause: herd mentality and fear of missing out, FOMO, drive investors to follow the crowd rather than making informed decisions. Avoidance: conduct thorough research and focus on the fundamentals of the investment rather than succumbing to market hype. 2. Ignoring diversification. Putting all your eggs in one basket is a classic mistake that can lead to disastrous outcomes. Failing to diversify exposes investors to significant risk if a single investment performs poorly. Example: Enron's collapse in 2001 left many employees and investors with substantial losses because they had heavily invested in the company's stock. Cause: overconfidence in a single company or sector can lead to overconcentration in a portfolio. Avoidance: diversify across asset classes, sectors, and geographic regions to mitigate risk and reduce volatility. 3. Timing the market. Attempting to time the market by predicting its highs and lows is notoriously difficult and often results in poor investment decisions. Even experienced investors struggle to consistently predict market movements. Example: investors who sold their holdings during the 2008 financial crisis at market lows missed the subsequent recovery and gains. Cause: emotional reactions to market volatility can lead to impulsive decisions. Avoidance: adopt a long-term investment strategy and maintain a disciplined approach, focusing on time in the market rather than timing the market. 4. Falling for Ponzi schemes. Ponzi schemes promise high returns with little risk, luring investors into fraudulent operations that eventually collapse when there are no new investors to pay returns. Example: Bernie Madoff's Ponzi scheme defrauded investors of billions of dollars before it was uncovered in 2008. Cause: greed and the allure of quick, guaranteed returns can cloud judgment. Avoidance: be skeptical of investments that promise unusually high returns with little risk and conduct due diligence on the investment's legitimacy. 5. Over-leveraging. Using excessive leverage or borrowing money to invest can amplify gains but also magnify losses. Over-leveraging can lead to financial ruin if investments do not perform as expected. Example: the 2008 financial crisis was exacerbated by excessive leverage in the housing market, leading to widespread defaults and financial instability. Cause: the desire to maximize returns can lead investors to take on unsustainable levels of debt. Avoidance: use leverage cautiously and ensure that you can cover potential losses without jeopardizing your financial stability. 6. Ignoring red flags. Investors sometimes ignore warning signs about a company's financial health or ethical practices, leading to poor investment outcomes. Example: investors in Theranos overlooked red flags about the company's technology and management, resulting in significant losses when the company collapsed. Cause: confirmation bias and emotional attachment to a company can lead investors to ignore negative information. Avoidance: stay objective and critically evaluate all available information, including potential risks and red flags. 7. Overconfidence in personal judgment. Believing that one has superior knowledge or insight can lead to overconfidence and reckless investment decisions. Example: investors who believe they can consistently outperform the market by picking individual stocks often end up underperforming due to overconfidence. Cause: cognitive biases and a lack of self-awareness can lead to overestimating one's abilities. Avoidance: acknowledge the limits of your knowledge and consider seeking professional advice or using diversified investment vehicles like index funds. 8. Emotional decision-making. Allowing emotions like fear, greed, or impatience to drive investment decisions can lead to irrational choices and financial losses. Example: panic selling during market downturns or buying during speculative bubbles are common emotional reactions that lead to poor outcomes. Cause: emotional biases can cloud judgment and lead to impulsive actions. Avoidance: develop a clear investment plan and stick to it, regardless of short-term market fluctuations. Practicing emotional discipline is key to successful investing. Conclusion: ridiculous investment decisions often result from a combination of emotional biases, lack of research, and overconfidence. By recognizing these pitfalls and implementing strategies to avoid them, investors can make more informed and rational decisions. Conducting thorough research, maintaining diversification, exercising caution with leverage, and practicing emotional discipline are essential components of a successful investment strategy. Learning from past mistakes and staying informed about market developments can help investors navigate the complexities of the financial world and achieve their long-term financial goals.